In this video, I'm sharing details of the 4 most important financial factors that have shaped and continue to influence our financial landscape in the 36 years since Seoul 1988, and they are inflation, the inevitable increase in the price of everything we consume over time, returns from cash, what you get if you put your money in the bank, property, our sometimes irrational love affair with owning bricks and mortar, and investments, ooh, risky. And remember, they can go down as well as up. I'm going to look at how each has impacted £1,000 since 1988. And if you make it to the end, you'll enjoy a direct comparison with the return of buying an average price house as an investment or investing that same amount of money in the UK stock market. These charts all show what's happened to £1,000 since 1988. All the way up to 2024. That's 36 years, which is a bit less than most people's working lives and a bit more than most people's retirement. But you get the picture. First up is inflation. This is the black line. First thing to notice is the sudden increase in inflation in the past couple of years. Prior to that, it's been pretty steady. So in 1988, a basket of goods and services that cost £1,000, well, that same basket of goods and services would actually cost £2,770 in today's terms. That's nearly tripled, and it's an increase of 177%. And you can see how the black line has moved, and it's the baseline that we need to compare our financial landscape against. Next up is cash. This is the green line. Now, finding a measure of cash deposit interest rates is a challenge, so I've used the Bank of England base rate as a proxy for savings interest. It's not going to be exact, but it will be close enough for the purposes of this video. Notice how this line changed in response to the credit crunch in 2008 when the Bank of England reduced its interest rates to a 350-year record low, and the recent uptick as the Bank of England increased interest rates significantly to try and bring spiralling inflation back under control. So £1,000 put into a bank account that received the Bank of England base rate as interest would have grown to £4,634 since 1988. That's a 363% return since 1988, and it assumes interest builds up in the account each year to benefit from compounding. So cash has maintained its spending power, having outpaced inflation, the black line, over that 36-year period. Now, the increase in property is a bit more difficult to model all the way back to 1988. So what I've done is use data from the Office of National Statistics, easy for me to say, for house prices in England. Now, I've done this not because I want to alienate my fellow Celts, but because most houses are in England, and average house prices in England will typically be higher than those in Northern Ireland, Wales and Scotland. So we'll show more buoyant returns for property. So property is shown by the blue line. Notice how property prices have increased significantly whilst the cost of borrowing money was at a record low interest rate, the green line, once the initial shock of the global financial crisis had subsided. Also see how property prices have declined recently since the Bank of England has increased the cost of borrowing to try and get a handle on inflation. Fewer people moving, so less demand leading to falling house prices. So £1,000 worth of property in England in 1988, and yes, I know you couldn't buy a house for £1,000 in 1988, but I'm trying to compare apples with apples here, so go with me. I'll look at the cost of an actual house in 1988 shortly. So £1,000 worth of property in England in 1988 would be worth, on average, £7,006 today. That's an increase of 601%, which is not a bad return, and you can see how it compares with cash deposits and inflation. But how does it compare to investing in the stock market? Cue the star of the show, stocks and shares investments. This is the red line. The red line is £1,000 worth of UK equities. For the technically minded, it's the growth of the FTSE All Share Index, and it dwarfs the returns from property and cash. And yes, I know I've ignored fund charges with the red line, but I'm trying to illustrate concepts. For completeness, I've also ignored council tax and property maintenance costs for the blue property line, and I've ignored any income tax deductions on bank account interest received in the green cash deposits line too. It's the relative difference between these lines I'm aiming to illustrate here. So £1,000 invested in the UK stock market in 1988 would have grown to £18,497. That's an increase of 1,750%. For a bit of perspective, during that same period, these are just some of the events and crises that have occurred and had a negative short-term impact on the UK stock market. Ready? The first Gulf War, Black Wednesday, the dot-com bubble, 9/11, the second Gulf War, the credit crunch, the Greek debt crisis, China crash, Brexit, COVID, Russia's invasion of the Ukraine, and double-digit inflation. The difference in returns between cash, property and shares is nothing short of stellar. Just stare at the lines for a second. For every £1,000 invested in property instead of shares, property investors have missed out on £11,491 of investment return for each £1,000 they had invested in bricks and mortar over that 36-year period since 1988. Let's look at that another way. In 1988, the average house price in the UK was about £52,000. Let's compare buying an average house in the UK 1988 as an investment versus putting the same amount of money into the UK stock market. Now buckle in, because the difference is truly staggering. But before we go there, it would be good if you could help us grow this channel by hitting the like button, clicking subscribe and ringing that notification bell so you don't miss out on our next video. And more people like you can find our content on YouTube. So if the increase in value of a £52,000 property mirrored the average increase in house prices in England, then it would be worth £535,856 in 2024. That's over 930% return, which I think you'll agree is pretty decent. Now, quick note, the actual average house price in the UK in April 2024 is about £281,000. The difference almost certainly being explained away by the phenomenal growth in house prices in the southeast of England, in particular London. Remember, the blue line is England house prices. But that money, £52,000 invested in the UK stock market, the red line, would have grown to a staggering £1,397,860, which is a growth rate of 2,588%. That's a little shy of £1.4 million after investing £52,000 for 36 years. And more importantly, it's an extra £862,000 compared to investing the same amount of money in a property for the same period of time. The problem here is because people think a 10x return on property is good, they ignore a 25x return they could have enjoyed if they had invested in the UK stock market instead. They miss out on more than £750,000 extra for tying their capital up for exactly the same amount of time. I can't imagine what difference it would make to a retirement with an extra £750,000 available to spend if I'd invested in the stock market rather than a property. Now, I think the real reason the uninformed will choose property over investments for long-term capital growth is that investments are valued daily and therefore can appear to fluctuate wildly in the short term. Properties, on the other hand, are valued much less often, typically only when they're sold. That's what the purchase price is. It's that property's value on that particular day of the transaction. The value of the property is just the price agreed between the seller and the purchaser. And also, properties are physical. People can see them, so people can feel like they can understand them. So investments feel much more volatile in the short term. But in the long term, equity investors get rewarded for exposing their capital to these short-term fluctuations with significant long-term investment growth. Because as we all know, risk and return are related, and not having enough money to do all the things you want to do in the time you've got left on the planet might be the biggest risk you take with your long-term investment strategy. Thanks for watching, and I'll see you in the next video.